It's the beginning of the trading week, which of course means it's time to take a look at the week ahead. Looking to see what's in store for the markets this week, I'm joined by Beauchamp, market analyst with IG Group. Chris, this week we'll see the release of US and UK GDP figures. How do you see these numbers performing, and what will this mean for the markets?
Well, a lot sort of rides really, I think, for both currencies on these GDP figures as they come through this week, which is the first real insight we get into the state of these economies in Q2. And of course, the theory for the US certainly is that there's been a decent recovery in that period, certainly pulling us back from the dire performance of Q1. So I think the GDP figures in the US will go a long way to really confirming or disproving that thesis. And certainly for the UK as well, we want to see continued recovery coming through, even though you had a fairly strong performance in Q1. Now, for both currencies, you've seen the pound come back quite a bit from the highs we had so far this year, by sort of 158 and more. And even though Mark Carney started hinting at rate rises, you've seen the pound continue to lose ground against the US dollar and against the euro as well this morning. So I think if you get a weaker reading, certainly for the UK, that does suggest that we do continue to see quite a bit of downside in the pound, pushing below probably 154 in due course. For the US dollar, well, it's GDP, of course, and then the Fed. But if you get a solid GDP reading, I think that will sort of give fuel to the fire that we will see some sort of movement in September, which is certainly what a lot of economists are predicting.
You've touched on the FOMC meeting on Wednesday. As you say, it's likely to give some sort of indicator to a rate decision, yet it almost seems to be a given that we should see something in September. Because of this, will we see much market reaction come Wednesday?
It depends how generous the Fed's feeling, I think, on Wednesday with its statement, because this is a central bank that is sort of the excellent example of how to sort of not give anything away in terms of real indications of timing. And I think if you get something in the statement on Wednesday that suggests that September is much more likely, I think you will still get a fairly decent market reaction. I think the market, to any rate movement, whenever that comes, is going to be a significant move, I think. But even so, I think it will be short-lived because certainly given the fact that they're not supposed to move by very much, even when they do move, as Yellen says, worry about the sort of pace rather than the actual movement itself in the first instance, then you could quite clearly see any dollar bounce be fairly short-lived, the classic sort of buy the rally, buy the rumour, sell the news movement coming into play there.
Chinese stocks fell sharply today, leading the Shanghai Composite to record its largest one-day drop since June 2007, while bringing down European shares and US futures. Chinese investors seem to be back on the bear train, likely coming from the belief that the government's intervention is unsustainable. What do you think? Well,
the old cliche is still there, isn't it? You can't buck the market, and I think China maybe thought it could at least get some sort of short-term breathing space, but they're probably hoping for longer than they got. And of course, really, you can ban short selling, and you can put the sort of big shareholders under an interdict not to do any selling, but the rest of us are still open to it. So I think actually China's learning a lesson here that you really can't stand in the way of market forces if you're trying to run a really free stock market. And I do think we'll see continued losses. Plenty of people are probably sitting on paper losses even now. Will be looking to sort of get out of those as quickly as possible. So they did their Canute Act fairly well, I think, for a short term, but I think gravity is about to reassert itself.
Are there any other areas across the markets you think our viewers should keep an eye out for this week?
Well, I think the strength in the euro is a very interesting one, really. The interesting thing, of course, the fact that it went down after the Greek deal, it then started to rally, and that will continue, I think, to make life difficult for European indices, really. It has been sort of the correlation of the year that you see the euro going up when indices fall and vice versa. Given, I think, concerns that Greece is still lurking in the background and could resurge, I think you might see people still buying the euro and abandoning equity indices in order to some sort of safe haven, if you like, at least, in the short term. So that's the key one, I think, to watch out for. And obviously, earnings season grumbles on, but earnings expectations have been so low that they really haven't been able to inspire the market. So I don't see much coming to the rescue of equity indices that look overstretched, I think, at best at the moment.
So that's just some of the events in the market to keep an eye out for this week. For more in-depth analysis like this, make sure you keep clicking back to Dukascopy TV.